An opinion on this one. Julia, welcome to the program. Yes, revenues expected to be lower, but sales still looking good. You know, we heard about margins in that story to lead in. Is it just, that A2 Milk is just priced for perfection?
Nadine, you know that this is a stock that's probably made the most amount of profit for my portfolio over the last 3 years. And I guess the key as an investor is to work out whether this upgrade cycle is over or whether we're just seeing a hiccup in terms of the share price. In terms of the actual update, and if we have a look at it, they're predicting that FY18 revenue is going to come in between 900 to 920 million New Zealand dollars. Now, consensus was at $947 million. So to that midpoint, that's a downgrade of around about 4% to consensus. So it's not a huge downgrade. It's not the company's own forecast, it's the market forecast, and it looks like the market's just gotten ahead of I guess growth expectations in terms of this stock. So I guess then you have to ask yourself, well, is the growth story over? Having a look at the growth story for A2 Milk, back in FY16, this is a stock that saw revenue growth of 127%. Last financial year it was 56%, and look, this financial year they're predicting growth of 64 to 67%. So it's still not bad. It just means that I guess the market was expecting a bit more from A2 Milk. And I guess it's good to remember that this is the type of market where you really do need a stomach of steel and you need high conviction in terms of your stock, because there's a huge amount of volatility. Remember, Bellamy's last year traded at as low as $3.65. It's now above $17. And WiseTech, another growth story, back in February when it came out with its results and disappointed, the stock fell 23% in one session. Today it was over $14 again. So look, I think the biggest question is that growth story over? For me, it's not. There was an additional announcement today from Coles that they'll be looking at selling some infant formula under the counter in some stores. But I can't really see Coles looking to cannibalize a huge section in terms of its sales. It looks like it's specific stores at the moment. And I guess the other thing we'll be watching is the MSCI index rebalancing, and of course A2 Milk being included as of the 1st of June.
Now, Julia, some good news from Computershare. That run continues. Is that still good value to you?
Look, Computershare to me is a company that has been looking for growth. It's been making a few small acquisitions, and I guess in terms of its major areas, it's been struggling to find that growth. The low quality mortgage processing in the US is now around about 25% of group revenue, and if you have a look at the core business of share registry as well as corporate actions, that's seen revenue in decline. So look, today we've heard that they're buying this European share plans business for about $419 million. Given the size of Computershare, it's not huge in the whole scheme of things, but I think Computershare's lift in share price, and the shares did reach a record high today, is mainly because of macro factors. And look, we did see US bond yields rising higher once again, and that benefits Computershare because when the money's sitting in the bank for Computershare with these corporate actions, it sees a rise in the interest it gets from that money that it has in the bank. But that also benefits insurers. We saw QBE Insurance Australia Group doing well, benefits the banks. We saw the banks doing well, but of course a negative for things like utilities and properties, which were underperformers on the market.
Jeremy?